Welcome back to The Breakdown with me, NLW. It's a daily podcast on macro, Bitcoin, and the big picture power shifts remaking our world. What's going on, guys? It is Wednesday, September 24th, and today we are talking about Tether's monster fundraise. Before we get into that, however, if you are enjoying The Breakdown, please go subscribe to it, give it a rating, give it a review, or if you want to dive deeper into the conversation, come join us on the Breakers Discord. You can find a link in the show notes or go to bit.ly/breakdownpod. Well, friends, AI has been having altogether too much fun relative to the world of valuations and big investments and investor focus, and Tether has now kicked down the door and said, no thank you, you don't get all the money. Yes, Tether is reportedly seeking external funding at a massive $500 billion valuation. Bloomberg reports that Tether is courting outside investors for the first time and reportedly looking to raise between 15 and 20 billion in exchange for 3% of the company, making their implied valuation $500 billion. Cantor Fitzgerald is acting as the lead advisor in selling the deal, extending their relationship with Tether even further. Cantor is, of course, the investment bank that used to have Commerce Secretary Howard Lutnick as its CEO. They've also been managing some unknown portion of Tether's reserves for at least the past year. One of the sources for the report did note that the numbers involved in the deal were top-end targets and eventually could come in lower. The deal is reportedly in the earliest stages, so all the details are subject to change. Still, the deal does seem to be real and something that CEO Paulo Arduino is happy to speak about. On Tuesday, he tweeted, "Tether is evaluating a raise from a selected group of high-profile key investors to maximize the scale of the company's strategy across all existing and new business lines: stablecoins, distribution ubiquity, AI, commodity trading, energy, communications, media, by several orders of magnitude." The tweet concluded with 3 pawn emojis in case that means anything about the chess game that Paulo is partaking in. He also signed off with Tether, the stable company, which is a turn of phrase we haven't heard before. Now, it goes without saying that this kind of fundraising is completely unprecedented in the crypto industry, and frankly, until about 5 minutes ago, with everything happening with AI, basically any other industry either. Tether has never publicly raised outside capital before, although we know their genesis involved a group of early crypto investors bankrolling the project. It's unclear if they've taken on further investors over more recent years, but if they have, it is definitely not at anything like this scale. $500 billion is a huge valuation for a private company. That is what OpenAI's recent tender sale has been at, and the list of companies at anywhere near that size is basically just OpenAI, SpaceX, and ByteDance when it comes to privates. As another comparison, fintech startup Stripe topped out at around $100 billion back in 2021. It's also worth reflecting on how wildly unlikely this outcome was. We've been covering Tether on this show since the very beginning, and there was a period there where it was not guaranteed that they were going to make it. Between 2019 and 2021, they fought a lawsuit against the New York Attorney General, who claimed that Bitfinex had used Tether to cover up an $850 billion hole in their books. Throughout the legal proceedings, Tether repeatedly failed to deliver audited financials, and there was a long-running suspicion that Tether didn't have the reserves to back their stablecoin. That sentiment is no longer prevalent. Tether is in a completely different era. Paulo Arduino is free to visit Washington and meet with administration officials, and Tether is planning to launch a fully regulated stablecoin in the US. The news sparked a wide range of responses, one of the most common being why a profitable company would need to raise money. Tether's most recent financial disclosures have claimed the company is making around $5 billion a quarter, making them one of the most profitable private companies ever. It is crazy to me, and I'm sure we will explore this more on the Friday 5, that this would even be a question. The thing that companies do, especially companies that are good enough to get to where Tether has gotten, is grow. They build more stuff, they do more things, they move into orthogonal areas, they take over stuff. And yes, Tether has a big old balance sheet to self-fund a lot of that motion, but if you could raise $20 billion for 3% of your company and increase your ambition by 100%, the trade seems very clear to me. Now, there are some more mechanical reasonings. One possible explanation, for example, is that Tether needs to set an independent valuation, either for their own purposes or for the benefit of shareholders. This year, for example, you see a ton of crypto money coming back into the regulated financial system via products like the Bitcoin ETFs and treasury companies. And it's not completely absurd that some Tether shareholders might want to take loans against their equity. To do that, they're going to need an independent valuation. For example, Cantor Fitzgerald themselves reportedly owns a large chunk of Tether as a strategic investor. The Wall Street Journal reported last November that Cantor owns a 5% stake, and the report stated that Cantor valued it themselves at $600 million. If this deal goes through, that equity stake would be worth $25 billion, clean and clearly valued by outside investors. There is a huge amount of value in establishing that stake as good collateral in the banking system. Notably, the reporting said that this fundraising would involve issuing fresh stock. In other words, this is an exit liquidity for existing shareholders. The deal could also drastically change a lot of numbers across the industry. Circle, which isn't that much smaller a business than Tether, is currently worth around $30 billion in market cap. Even Coinbase is only an $80 billion company. We have no idea how Binance was valued when Abu Dhabi's MGX invested $2 billion in March, but it probably wasn't $500 billion. Udi Wertheimer noted that the valuation of Tether, the company, is higher than Ethereum's. Mike Dudas of Six Man Ventures pointed out that the valuation is outsized even looking at the mega financial institutions. He tweeted, Tether would be the second largest bank in the world by market cap. Tether is worth 2 Goldman Sachs's. Now, there were, of course, the usual claims that Tether is raising because they still have a hole in their balance sheet. Frankly, if that were the case, it's a terrible idea to be doing a press tour and leaking the news to Bloomberg. Others instead pointed to a huge range of new positions that Tether is hiring for, giving at least some credence to the idea that they're expanding new businesses in commodity trading, energy, and communications. Presumably, Tether will have no shortage of investor options, but we'll still stay tuned to see how richly they're valued once the deal closes. For now, Moon Overlord had just one big takeaway, tweeting, if you're trading badly lately, just remember, there was a guy on here who spent years making his entire personality an anti-Tether one, and now they're worth $500 billion. In other fundraising news, CZ has denied that his venture fund is taking on external investors. On Tuesday morning, the Financial Times reported that CZ's $10 billion fund, YZ Labs, was considering opening up to outside investors. YZ Labs was formerly known as Binance Labs and spun off from the exchange in January. The reporting even included a quote from Ella Zhang, identified as the head of YZ Labs, who said, there's always a lot of external investors interested, and we will eventually consider turning it into an external-facing fund. We just think it's not there yet. In AI and biotech, we're still early. We're forming our team. When we have that expertise, we have the confidence level, we'll open up for external investors. Zhang also said that the SEC had sought a private demo showcase of some of the companies backed by the fund. Apparently, CZ feels completely different about the situation, taking to Twitter to proclaim completely false news from the FT. Old heads will be shocked that he didn't show a picture of himself holding up 4 fingers. CZ continued, YZ Labs is not raising external fund. There is no demo. WTF is a demo for a fund. There is no pitch deck for YZ Labs ever, not even preparation of one. YZ Labs, since rebranding, has not sought a single external investor. No requests, no discussions. There has been no demo, no communications with Chairman Paul Atkins from YZ Labs or me. He ran through a series of other disclaimers, largely about the FT characterizing his criminal charges as money laundering rather than compliance violations. CZ concluded, FT tried for a long time to lure me to a lunch interview, promising it will be a positive coverage. I almost did it last week, but I was busy last minute. So Ella had lunch with them first, and this is what came out. It was a trap. Canceling that lunch now. Zhang also checked in and disclaimed the story, stating that things were still all good between her and CZ. Tigran Gambarian, a Binance compliance officer who spent 8 months in a Nigerian prison on trumped-up charges last year, commented on the journalistic integrity at the FT, tweeting, hang in there and stay strong, they tend to do that. If you roll with CZ, they'll come after you. Now, aside from being an utterly bizarre story, the week has really cemented that CZ is back to being a main character in crypto after lying low for a while after his prison sentence. As he was going to jail, CZ resigned as the CEO of Binance and said that he would be moving on from crypto to focus on biotech investing and an education startup. He's back to tweeting every day, and the tone of the coverage is reminiscent of the last cycle. We also now know that CZ has a $10 billion venture fund investing in a mix of crypto and biotech. So is this a temporary resurgence of CZ onto the crypto sphere, or something more sustained? We will have to just wait and see. Speaking of Paul Atkins, who got a passing mention from CZ, the SEC is considering an innovation exemption to fast-track crypto products. In an interview with Fox Business on Tuesday, SEC Chair Paul Atkins said that the SEC was looking to finalize crypto rulemaking over the coming months. As one example, he said, we're looking for an innovation exemption to try to get that in place by year end. The SEC uses exemptions to allow various capital market activities which wouldn't otherwise be allowed. One notable example from the past decade was the crowdfunding exemption that was adopted in 2015. To get a sense of how powerful these things can be, that exemption created the entire phenomenon of Kickstarter-style businesses and other similar methods of microfunding for small ventures. Closer to home, many crypto projects issue their tokens under exemptions that allow unregistered securities to be sold to qualified and foreign investors. Atkins didn't elaborate on exactly how the innovation exemption would work or what would be allowed. However, he said the idea is that it would allow crypto firms to quickly, quote, bring on-chain products and services to market. Atkins also covered the generic listing standards for crypto ETFs, which were recently adopted, saying, they were another example of how we can move forward. It's not just an ad hoc type of approach. We're trying to give the marketplace some kind of stable platform upon which they can introduce new products. Besides all that, Atkins mentioned that the SEC is moving at full speed. He commented, my hands are full right now, and we are working hand in glove right now with the CFTC. So harmonization is really what I envision. Speaking of the CFTC, that agency is launching a new initiative to allow tokenized collateral on regulated venues. In February, the agency tapped Coinbase, Circle, Crypto.com, MoonPay, and Ripple to take part in a pilot program. Under the terms of the pilot, they would offer non-cash collateral using distributed ledger technology. In announcing the new initiative, acting CFTC Chair Caroline Pham said that the use of tokenized collateral had the potential to increase efficiency and transparency. Cutting through the jargon, the point is to allow stablecoins and potentially other crypto assets to be used on registered derivatives exchanges. The thought is that traditional derivatives markets could benefit from the faster liquidations that are utilized on crypto exchanges. It would also allow crypto venues to offer regulated markets in the US while keeping the infrastructure that makes crypto derivatives more efficient. Alongside the initiative, the CFTC is asking for public comment from industry stakeholders, with the comment period closing on the 20th of October. FAM struck a fairly certain tone, however, commenting, "The public has spoken, tokenized markets are here, and they are the future. The CFTC continues to move full speed ahead at the cutting edge of responsible innovation, and I appreciate the support of our industry partners." So friends, lots of interesting things happening. I am certainly very excited to see what happens with this big Tether deal. For now, though, that is going to do it for today's breakdown. Appreciate you listening as always, and until next time, be safe and take care of each other. Peace